Now, I might not have a yellow lamp anywhere in my background, but I hope you'll join me nonetheless in this video where I'll talk about one thing you should consider before buying ETFs and index funds. Welcome back to another video. Subscribe, hit the like button, the notification bell if you enjoy it. Drop me a comment if you have any questions, and let's get straight into the video. Now, the majority of retail investors and you watching this video most likely have investment portfolio made up of ETFs or index funds. And most YouTubers, financial advisors, myself, your parents or your friends will most likely recommend these to you if you want to start out investing. And despite what I'm about to say about index funds, I do recommend them occasionally to friends and family because they are simply very tough to beat, and it will be the right choice for 80 to 90% of investors. And if you just put your money away in an index fund and never look at them again, you will most likely beat most other investors. So if you invested in an index fund like the S&P 500, which consists of the 500 largest publicly traded companies in the US, the return would be about 7.3% without dividend reinvested and 9.5% with the dividend reinvested. And if you add on dividend, the tax on the dividend, management fee and inflation, a $1,000 investment would turn into $12,730 years later today, a total return of $1,170. So as you can see, the returns can be quite fantastic even in a slow moving index fund, but it depends what time period you're looking at. From the year 2000, for example, the return of the S&P 500 has been a mere 3.6% without reinvested dividend. This was caused by the great financial crisis in 2008 and the corona crash in 2020. So when people say that, you can't go wrong with an index fund, you cannot lose money in a 10 or 20 year period, well, that all depends on what period you're looking at. Now, this, however, is something the investment industry and your broker and your bank and financial advisor don't want you to know, because they want you to give all their money, put it in their index fund, pay them a management fee, and never look at your money again. Because, the average investor picking their own stocks only make about 2% a year, right? So why would you try to be one of them? Just give us all your money and never worry about them. Because make no mistake, your bank, your broker or ETF provider like Vanguard or Fidelity are part of the investment industry, and they are all too keen on you parking your money in their passive investments, paying a management fee. And what they especially don't want you to think about is the damage those fee does to your returns. Now, did you know, for example, that the difference between a 0% management fee, which is picking your own stocks, and a 1.5% management fee over 30 years is? Well, $1,000 in an index fund charging 1.5% a year would turn into $54,700 at a 6% growth rate. So that's the S&P 500 return minus the fee. Well, while an individual stock also doing 6% a year, but with no management fee, will turn into $73,300. And the only difference between those two numbers is the small 1.5% management fee. Because you see, if the return of an index fund is 6, 7 or 8%, a 1% fee is more than 20% of your total return. And the money you pay in fees could have turned into more money, meaning that the damage the fee does to your portfolio grows exponentially over time. Now, I personally started out with ETFs, but I decided that I could do better, because as I picked my own companies, I noticed that they were far outperforming the index funds. I do nothing fancy. I just invest in well-known growth companies, mostly big US tech companies that everyone knows about. And most of the money I've made from the stock market has come from these winners like Amazon, Tesla, or Activision Blizzard. And I stick to investing in secular trends like automation, e-commerce, cloud computing, renewable energy, electrification, data centers, and so on. Nothing fancy, big things that we all know is going on. And my biggest winners like Amazon or Activision Blizzard or Tesla has appreciated hundreds of percent. My Amazon position has appreciated almost 800%, meaning an index fund will never catch up. These winners actually makes up most of the money that I've made over the years, although I have held some index funds and some dividend paying stocks, but they can never catch up to these big winners. And you might be thinking, well, I can do better as well. I'm sure you can. Think of any company you think have outperformed the stock market without looking at the graph. Microsoft, Apple, Tesla, Nvidia, Netflix, Facebook, Amazon. Well, you'd be right. In fact, they've been the most popular and most talked about stocks for over a decade now. And they have massively outperformed the stock market. And I'm fairly certain that most of my viewers, if given the chance 10 years ago, would have put most of their money in these companies because they were obviously going to outperform. Hindsight is 2020, and it's easy for me to sit here and say this, but I've invested in almost all of these companies and crushed the market ever since 2013 when I started investing. And in those 7 years, the FANG stocks, Facebook, Amazon, Netflix, or Google, or FANG if you add Apple in there, have surged 690% for Facebook, 990 for Amazon, 277 for Apple, 3,630 for Netflix, 320 for Google. That is compared to the index S&P 500's 117. So these companies have not only been the most obvious companies to invest in, they've been the most popular, they've been the biggest companies, the biggest winners, but they've also outperformed the stock market. So if you were investing in, the stocks that everyone have been talking about for the last 7 years, it would have been tough not to crush the market. And I get that the 7 years I've been investing ain't much to go on, and the stock market has been around for hundreds of years, where index funds and passive investments have beat those who try to go outside them. But this sums up what I've been witness to over those 7 years, and why I've chosen to leave passive investing and do it all by myself. I want to decide where my money is invested, and so should you. The entire investment industry will tell you that you are not smart enough to beat the market, but I think you are. Hindsight is 2020, and I'm making a video after the fact. But here I am, a Amazon, Nvidia, Tesla, Microsoft, and Activision Blizzard shareholder. So I did what I'm talking about in this video, and I'm going to continue beating the market. In fact, I have outperformed the index by a wider and wider margin for every single year, 2020 being the year I've beaten the index by the most so far. So it seems like I'm getting better at it as I see how easy it is to avoid the trap of passive investing. But again, the investing industry, your broker, don't want you to think about this. They don't make money from you buying a growth stock and holding it for 30 years and then cashing out. The only one making money on that is you, the company, and the government collecting the tax. So again, why would any investing firm or bank or financial institution recommend you go out there on your own and invest in companies? Because they don't make money from that. So here's my suggestion. You can do much better than 6 or 8% a year. Sit down, make a big list of the companies you think will outperform in the future, the companies innovating and disrupting the current state of things, and look at some big global trends. We all know some things that are going on. Automation and robotics, e-commerce, electrification, the rise of cloud computing and software, clean energy, blockchain, peer-to-peer economy, new types of shipping methods, drones, whatever it might be. These are trends we all know are going to happen. So try and find companies that are going to make a profit from these big shifts happening in the future. Don't look to the past, look to the future. That's where you're going to make money. So the opportunities and possibilities are endless. There are thousands and millions of companies out there that you can have a look at and find out which one is going to do better in the future. And there are some certain things to look for. So why would you settle with an index fund where you just spread your money out between 500 companies that you don't know anything about, when there are so many exciting growth stories out there for you to invest in? So go out there, pick your own stocks, be the cogwheels that makes capitalism work. None of this passive investing bullshit. Give the money to the companies that deserves your money, and they will take your money and turn it into more money like magic. Hope you enjoyed this video. Let me know what your thoughts are on this topic. I know a lot of people have some index funds and some ETFs, but then they also pick their own stocks on the sides, which I think is a great way to go about it, and the way I would recommend people start the shift from passive to active investing. Hope you enjoyed this video, and I do hope I'll see you for my next one. See ya.